What's going on, guys? David Piatek here, and today we're talking about credit basics for future home ownership. Credit score has a significant impact in life, and especially when it comes to getting better credit terms as far as getting lower interest rates, getting lower fees for the same product as somebody that has bad credit. They're typically going to have much higher costs associated with that, right? And what a basic credit score is, it's a numerical number, right? Depending on the type of credit score you're looking at, because there's hundreds of different models that are out there, anywhere from, the type of, if you're getting a home insurance, if you're getting a car, a mortgage, a credit card, a personal loan, all those credit scores are going to be different across the board, right? But today we're really focusing on what mortgage credit scores look like. The good news is really there's no difference at 740 or higher for credit scores as far as the impact on mortgages, but it definitely has impact on your interest rates, right? So the lower your credit score is, the higher your interest rate is, and the higher fees you have. So one of the best things to be able to get the best interest rates that are out there is to focus on your credit, right? So sometimes people might have some blemishes on their credit report, which is not a big deal. Those things just take time in order to update and not affect your credit anymore. So typically, what they look at is the last 24 months of credit history is kind of what they focus in on. Yes, if you have late derogatory credit like collections and, other lates that were before that 24 month, they're definitely going to have some type of impact for as far as what a lender looks for to be able to approve somebody for credit depending on what it is. Now, the good news is that after 7 years, pretty much all derogatory accounts fall off your credit report, giving you a fresh start, right? The challenge is that people will relapse and have lates and just kind of restarting that timeline. But that's why it's very important to budget. And that's going to be some of our videos that are going to be coming up, is really focusing in on how to control finances, because that's a primary driver for how it affects your credit, right? If you don't have savings, a life event happens like losing a job, well, you're able to keep making your payments and keep your credit in good standing, right? Everybody needs a place to live. Unless you're living with your parents and saving money, good for you. But at some point, they're going to kick you out and you're going to have to buy a place. So all these things matter in life because, again, like I mentioned, is that the better the credit, the less cost you have to be able to get things that you need, right? Especially let's think about like credit cards, right? There's 21 month 0% interest credit cards out there right now that people can get. So if you have a house emergency or a life event, a funeral you have to pay for, you could take out a credit card and pay for it and then pay it off over time versus, let's say, having bad credit where your interest rates are at 35%. And then you're just getting bombarded, or you're just paying nothing but interest on your payments, which is really not getting you anywhere. So this is kind of why it's important to understand that makeup. So there's a couple components of a credit score that determine what the actual credit score is going to be driven by. Now, they keep this, it's how they actually calculate it is a secret. I don't know why this is a secret when your whole life is determined by this. But the thing is that it's going to be based on your payment history, right? So how often do you make your payments on time, right? That's going to be one factor of it, and how much you actually make the payments on, right? So if you make the minimum payments, lenders look at what's called trending data, and that trending data is going to show them how, yes, you make your payments on time, but then how do you make those payments, right? Are you making the minimum amount of payments, which can trigger that someone is overextended and not being able to pay down debt? Which also kind of goes into that second piece of credit utilization. The higher your credit utilization is, the lower your credit score is. So sometimes we'll look at people's credit reports and we'll be like, man, this should be a 780 credit score, and they only have a 620 score. The reason being is that they, let's say, have a $10,000 limit on a credit card and they've maxed out that credit card to the $10,000. That's going to have a negative impact And if you go over your limit on what your balance is, that will also accelerate and increase how much your credit scores go down. And just one thing on payment history, it takes a lifetime to build credit, and it could take one event to kind of take all that down. Because on average, one late payment, it equals about 70-point reduction in your credit score, which is mind-blowing, but it's just something that you got to keep in mind. Another factor when it comes to your credit score is how long you've actually had that credit card. So think of it this way. If you think of it like personally, right? If you if you make your payments on time for 10 years, that's a good amount of length to have as a history, right? Where versus someone else that, let's say they've only had credit for 2 months, you really can't tell how their payment history is because it's just too short of a time. So credit scores will reflect that as well. So if you just started getting credit, it's going to take about a little bit of time to kind of come to its own to be able to reflect kind of the on-time payment that you have. A lot of times people ask me is how many credit cards should I have? Typically, you're looking around 3 or 4. You don't need more than that. If you have more, does it necessarily affect you? I've kind of seen it all, and I really don't see that. As long as you're not utilizing a lot of credit, that's kind of the key component to that. Another factor of credit score itself is going to be how many new credit inquiries do you have? Now, the misconception is that if it depends kind of where you're looking, right? So mortgages have a 45-day window that you can pull unlimited credit and it'll count as one credit pull. Yes, when you pull credit, there'll be an initial dip. But remember, when the credit is pulled, at that time the credit is pulled, the score is what it is, and then it drops from there. Now, from the lending side, after 90 days, it doesn't have an effect anymore on your credit score. So a lot of credit bureau or some of these like Vantage Score, if you have a FICO score like the free one, or with your credit cards, your bank account statement, whatever it is, those are going to show 2-year history of credit inquiries, which I don't know why they do that, but they do it. From the lending side, we don't care. And the other thing they kind of lump together is car loans as well. So if you have multiple credit inquiries, they'll end up counting as one for that. But again, mortgages, 45-day grace period to have unlimited credit inquiries count as one. Does it make sense to do that? No. Find someone you trust. Find someone that could walk you through the process and just work with that person. Now let's talk about the type of credit used, because that's another factor when it comes to your credit score. So what they want to see is a blend of, do you have a credit card, an installment loan, that'd be like a car loan or a personal loan, and a mortgage as well, right? Because that kind of shows a good credit mix, I guess that's what they say, to the credit agencies to say, hey, you're able to have different types of accounts, you make all your payments on time. And remember, the longer you have credit, the better your credit score is going to be. So over time, it evolves and becomes better, even though you're not doing much. Because again, it's looking at how you're paying your debts down. So that to make your payments on time, limit how much credit you take out, and utilize what you need, and then just pay it off as fast as possible. Now, when it comes to improving your credit health, kind of from an overall component, right? Some of the things are kind of a no-brainer, but how do you determine, let's say if you do have a life event, how do you pay your bills, right? If I'm renting a property and I also have credit card debt and I lose my job, how do I determine where should I be, allocating my money? Just remember, your credit, once you have a late on that credit report, and this is kind of the challenge for a lot of people is when they have to make these types of decisions, is that remember, there's a 2-year at least reset to be able to get your credit score up. And then you are waiting at least 7 years before that derogatory credit completely comes off your credit report. Is that going to stop you from buying a property, especially when using your VA home loan? No, it's not, right? As long as the late is more than 12 months out on a VA loan, you're pretty much good to go. Just make sure that your credit and everything else has been is going back up, and that's what you want to be able to do, right? The other thing is there's different ways to pay off debt when you have it. is either you pay down large sums, like the biggest credit cards first with the highest interest, right? Because you don't want to pay down low interest credit cards first because that's kind of cheaper money. You always want to pay off expensive money first, right? But the key is to keep low balances on your credit card. A lot of people, like even myself, use credit cards because I want the points, right? If I'm already spending the money, I want some of that money back, at least some of it, right? But you have to be careful with that because you really should be treating the credit card like a charge card. A charge card is kind of like an American Express Platinum card, where you pay it off every month, but they recently changed some of that. So now it kind of acts like a credit card, but you want to be able to pay off your bills on a monthly basis, right? Some people do it on a weekly basis, but you need to track it because it's part of your budget. Don't open too many credit cards at once. That's just something that it could take a big dip on your credit report. But at the same time, right, you got to be realistic is that, some people don't need to, let's say you already own a home, you're just trying to figure out a budgeting component, right? You want to be able to take out 2 or 3 credit cards to be able to transfer balances because you had something happen, you got offers for 0% interest credit cards. Okay, it can make sense, right? But this is all going to be just kind of a situation, whatever your situation is, and everyone's unique. So sometimes it's hard to do these videos when, we kind of talk about, hey, this is the strategy, but everyone's is going to be a little bit different. And again, this credit piece, a lot of it's controlled by your budget and your spending, right? How much money are you actually spending on things? And if you're spending more than you're making, then you're accumulating credit card debt, and then that debt is hard to pay off. But again, this is why all of this kind of goes into that. And we talked about the impact that your credit score is going to have on your mortgage, right? So kind of want to retouch on that because when your credit score is, let's say from a VA home loan perspective, under 640, you really get hit hard, right? With higher interest rates, typically about 0.5% to a full percent higher. You're definitely going to have some additional fees associated with that. So again, the cost goes up for having the lower credit. So sometimes, with the VA home loan, right, you have 2 major components. You have the eligibility, right? Do you meet the time and service and character of discharge, right? That makes you eligible for the VA home loan. And then you have the qualification component, right? Do you have the credit, the collateral, the capacity, right? What's your credit score and what's your credit history like? How much money do you make? And what does your, let's say your employment history look like? There's a ton of variables, so never disqualify yourself from that. And then if you need any assets for closing costs, right, you're going to need to be able to pay for that unless you get like a seller credit. You can always use like a TSP account. You can get gift funds, which is pretty cool with the VA home loan. You can get that gift fund from anybody, unlike any other loan product, because they require it to be from family members. VA is pretty loose on that. So if you have family with money, they can gift it to you. You can use it. Same thing if you're getting like, let's say VA disability income, you can use all that income right away. We've talked to a lot of people recently that have been awarded their VA disability. They've gotten a lump check and they're like, what do I do with this money? Which you kind of have to look at, again, your credit component is going to help you determine that. Now, when we talk about the credit scores itself, I mentioned earlier about Vantage Score. Vantage Score is a collaboration between the 3 credit bureaus, right? Experian, TransUnion, and Equifax. They got away from using the FICO score because it's a more expensive product to use, and they say it's more old school, right? But mortgage companies still look at those. So there's discrepancies that happen when clients or consumers or the veterans out there are looking at their credit scores. They might be looking at, let's say, Credit Karma, for example, and they'll say a 620 credit score. They're like, oh man, I don't know what's going on with this. And then we look at a FICO score from the mortgage side, right, specific, and it'll be like a 730. And you're like, well, why is there such a big discrepancy? And sometimes it happens the opposite. The credit score is going to be lower, and sometimes it's higher. The best ones really to look at is the FICO score itself. If you sign up for like Experian.com, you can like pay extra and get your FICO mortgage score. At least that gives you a better look at it, what that score is going to be to help you determine where you're going to be in that, process. So when you're talking with a lender, you're saying, hey, my credit score, according to FICO, is going to be a 720. What does pricing look like? What the interest rates look like? Which we're going to have a whole separate video just going over how to determine what's called a loan estimate. So if you're buying a property, how to make sure that you're not being taken advantage of, which we see it all the time, reviewing clients' information. So hope you guys learned some things here today. Please like, share, and subscribe, and I'll talk to you guys soon.